Hello and welcome to today's webinar on year-end tax planning. My name is Michael Jones. I'm a partner at the Melbourne office and I'll be your host today. Now today's webinar is being recorded and in the unlikely event of some technical issue happens, it will be available to view later today using the same link that you're on now. Before we get started, I'd just like to point out the interactive features of the webcast player that we're watching right now on. So below me, next to the timeline, you'll notice a speech bubble. That's the button to ask questions. So if you'd like a question or a comment you want to do, and you can do this at any time throughout the webcast, just click on the speech bubble. Fill in the form and then send it in. I'll then ask our tax specialists your questions. And what I encourage you to do is to include your name, perhaps include which state you're from and your email address. That way, if we don't get to your question during the webinar, we can follow up with you afterwards. And now for our topic, year-end tax planning in uncertain times. You know, the significant financial consequences that we're experiencing managing COVID-19, along with other sort of tax changes that will commence on 1 July 2020, I think means that this year even more judgment than usual is required when considering tax matters and making different choices. So while listening to our tax specialists today, I encourage you to consider your particular circumstances for this financial year, but also start thinking about the next financial year as well, because I think it'll have an impact in these times. The format today will be a 40-minute presentation of year-end tax planning matters. Then that'll be followed by a 20-minute panel discussion where I'll ask your questions to our tax specialists. Right, now, our first presenter is Gabrielle Cleary. Gabrielle's a tax partner in the Sydney office. She's an experienced tax advisor and a well-known author of leading tax publications. Gabrielle, could you please start your presentation?
Right. Good morning, everybody. It is certainly an understatement that the 2020 income year has been an unprecedented period for Australia, especially with the tragic bushfire season and the ongoing advent of COVID-19 we are currently experiencing. As a result, the taxation and financial implications for businesses and individuals is different to most years. While we still have the usual tax planning considerations of deferred the derivation of income to a future year and bring forward expenditure and tax deductions, there are a range of other issues which need to be considered in planning, not only for the 2020 income year, but for future years. This is especially the case as it is widely anticipated that there will be significant impacts to revenue and profits in 2021. As a result of these events, this webinar will outline some of the main issues which need to be considered from a taxation planning perspective in approaching the end of 2020. In accordance with the webinar, we propose to address the following topics. The changes to the corporate tax rate, which will take effect on the 1st of July for small business entities. The tax and the COVID-19 subsidies which are being provided by the government. Looking at the instant asset write-off and the accelerated depreciation deductions which are going to be available for asset purchases. The COVID-19 concessions which are being provided by the Taxation Office and the effect on franking accounts for this purpose. We're looking at the usual issues in relation to Division 7A and the taxation of trusts. Then we'll move on to individuals and we'll address the issues in relation to the main residence exemption for foreign residents and the issues around working from home. We'll then touch on the topic of superannuation. First up, we'll look at the changes to the corporate tax rate. With effect from 1st of July 2020, there will be a tax rate deduction for base rate entities. For those that aren't aware, a base rate entity is a company that has aggregated turnover of less than $50 million and has 80% or less of their assessable income in the form of base rate passive income. Base rate passive income includes such items as dividends other than non-portfolio dividends, being rent, royalties, interest, and net capital gains. With effect from 1st of July 2021, the tax rate for small business entities will shift from 27.5% to the 26% rate. While this is good as it will result in lower tax being paid by the companies, it also gives rise to considerations in relation to individuals, trusts and companies as to whether it be preferable to restructure to operate through a company in the future. Just to give an example, if we look at the situation of individuals, two individuals, adult individuals operating as either as beneficiaries under a trust or as partners in a partnership, the use of a company will result in a lower tax rate being payable where the taxable income of that business exceeds $202,000. Or if the person is a sole trader, a company will give a lower tax rate with effect from $101,000 of taxable income. Note that the use of a company will only be effective for these purposes if the individual is not needing that money for personal purposes or to spend. Otherwise, it's only effective if the company can retain the profits and defer the taxation to a later time. The effect of the tax rate reduction will also have effect on the payment of franked dividends. A reduction in a tax rate basically affects the franking credits that can be attached to a dividend which is paid. For while profits that were made in 2020 will be taxed at the 27.5% rate, the reduction in the tax rate with effect from 2021 will result in a lowering of the maximum franking credit that can be attached to any dividend which is paid. For example, a base rate entity who has paid tax at the 27.5% tax rate in relation to the 2020 year will only be able to frank dividends which are paid in 2021 at the 26% tax rate. And this may result in franking credits of the company being effectively trapped in the company and not being able to be passed on to the shareholders of that company. This can result in a permanent loss of the benefit of the tax paid. Now, this trapping of franking credits can only be reversed in a company where that company gets a subsequent increase in tax rate. Now, there might be an increase in tax rate where the company ceases to be a base rate entity and becomes a ordinary corporate entity and subject to the corporate tax rate of 30%. This could arise where the entity's aggregated turnover starts to exceed $50 million in a year. The other way which we can access those trapped franking credits would be the derivation of non-assessable and non-exempt income. Now, this is very relevant for this year because a number of companies under $50 million will have received Cashflow Boost payments. These payments are non-exempt, non-tax, non-assessable, non-exempt income, and as a result, they may enable a reduction in the franking credits being trapped in the company. Now, this is best shown by way of an example. So we'll take the simple example of a base rate entity which has taxable income of $1 million. It pays tax at the 27.5% rate, resulting in tax payable of $275,000. This entity is not entitled to the Cashflow Boost and results in a net income after tax of $725,000. If this company sought to pay the maximum franked dividend in 2020, it would be able to pay the maximum franking dividend of $725,000, and the franking credits that would be attached to that dividend would be $275,000. There would be no remaining franking credits available, and there's no remaining profit, so there's no trapping of the tax in that situation. However, if they pay a dividend in 2021, the maximum franked dividend would still be $725,000, but the franking credits that can be attached to that dividend will be limited to $254,730. This results in an excess franking credits being held in the company of $20,270, with no remaining profits being able to be available to pay those franking credits out. However, if we take the same situation with the company, but this company was entitled to the cash flow boost of $50,000 in the 2020 year, we still get the same situation of taxable income and tax payable, but the net income after tax will be $775,000. The maximum fully franked dividend that could be paid in 2020 would be $725,000, and the franking credits on that dividend would still be $275,000. However, there would be remaining profits in that company of $50,000, of which there's no franking credits attached. However, if we move to pay that dividend in 2021, the maximum franked dividend that can be paid is $775,000. So the full amount of the profit in that company can be paid, but the franking credits attached to that will be $272,297. The excess franking credits, which will be trapped in that company, will be $2,703. As you can see, there's been a significant reduction in the excess franking credits which are trapped in the company. And those excess franking credits will partly be able to be recovered by such a company because the cash flow boost, they should be getting another $50,000 in the 2021 income year, as long as they are still in business by the end of September. So as you can see, it's essential to consider the timing of dividend payments based on the circumstances prior to 30 June 2020. But the trapping of franking credits is not the only consideration. There are a range of considerations which need to be made in determining whether to pay a franked dividend and the timing of that dividend. In particular, these include the cash flow of the company and the working capital requirements that company will require going forward. Whether there will be franking credits being trapped as a result of payments being deferred to a following year, the impact of the cash flow boost and any other non-assessable, non-exempt income, which might reverse any franking credits being trapped, the current and future taxation position of the shareholders. Once a franked dividend is paid, the recipient will be potentially subject to additional tax payable if the person is an individual, depending on their relevant tax rate at that time. Also need to consider the time value of money. Would somebody prefer to be paying tax at a lower rate today as opposed to paying at a higher rate but in a couple of years' time? Looking at the future aggregated income of the company or turnover of the company, if the company is on that borderline of the $50 million turnover, if it exceeds that value, the tax rate will go up to the 30% tax rate and will most likely result in some of those trapped franking credits currently being available at the higher tax rate. And also take note that there will be a further reduction of the tax rate in 2022 to 25%. As a result of all these changes, it is suggested that companies should consult with their taxation advisor to determine the best position for the company's particular circumstances before deciding whether to pay a dividend or not. Moving on, we go into the tax concessions and the COVID-19 subsidies which are being provided by the government. As we mentioned, the cash flow boost is available to employers who have aggregated turnover of less than $50 million. The cash flow boost is split into two separate payments, two separate sections. There's a first boost, which is a credit for PAYG withholding, which is deducted from salary and wages during the period of January to June 2020. This is subject to a cap of $50,000 and a minimum benefit of $10,000 for those employers. The second boost payment is a payment which is going to be payable in relation to the BASs which are lodged between June 2020 and September 2020. And this additional boost is a benefit which is equal to 100% of the first boost payment and is paid to eligible businesses that stay active to September 2020. Now, in this case, there's no requirement for the second boost that you continue to maintain employees. The sole requirement is that the business remain active until September 2020, which is generally judged through the ABN still staying in existence and the continual lodgement of business activity statements. Now, these boost payments, as we mentioned earlier, are non-assessable, non-exempt income in the hands of the employer. This has different impacts depending on the type of entity that the employer is. The impact to a company, as we outlined in the example, the tax-free status can effectively be clawed back upon a payment of a dividend to a shareholder as a result of not being accessible in the hands of the company. There are no franking credits generated from this income. However, it does enable companies who have been subject to the reduction in the tax rate to be able to access some of those trapped excess franking credits. Where the employer is a trust, the cash boost tax exempt status can flow through to the beneficiaries. This applies irrespective of whether the trust is the fixed trust or a discretionary trust. While tax-exempt payments can sometimes result in a reduction in a cost base of a fixed interest in a trust by a unit holder or a beneficiary, the cash boost payments, as being non-assessable, non-exempt income, will not generate this reduction in cost base or any capital gains tax event which might occur. For people who are up to date, it's the CGT event E4 that will not be generated by distributing the Cashflow Boost payments through to beneficiaries. For any partnerships which receive the Cashflow Boost, the tax-free nature will pass through to the partners, and sole traders will just be exempt in relation to that income as well. The second subsidy, which the government is providing in relation to COVID-19, is the JobKeeper payments. Now, this subsidy provides a $1,500 per fortnight subsidy per eligible employee for the maximum period from 30th of March to 27th of September 2020. In order to get this subsidy, an employer needs to be an eligible employer. This requires that there has been the required decline in turnover since 12 months ago. The required decline in turnover depends upon the type of entity, the status of the entity which is attempting to receive the subsidy. For any ACNC registered trusts, the required decline in turnover is a value of 15% or more. For any businesses which have aggregated turnover of less than $1 billion, the required decline in turnover is 30% or more. And for any businesses with aggregated turnover of over $1 billion, the required decline in turnover is 50%. The way this required decline in turnover is determined is by comparing, usually under a basic test of comparing the GST turnover or expected turnover of the relevant month in 2020 or the relevant quarter in 2020 with the same period in relation to 2019, where the required decline in GST turnover is there, then that entity satisfies the requirements to be eligible employer and is eligible for the subsidy provided it does the relevant registrations. If the basic test isn't satisfied, there are a range of alternative tests which are available to satisfy this turnover reduction. These alternative tests generally apply to situations where the entity is a service entity, where the entity is only incorporated in the last 12 months, where there has been a significant increase in turnover over the period of 12 months prior to COVID-19, or there has been irregular turnover. If the alternative test is satisfied or the basic test is satisfied, that entity is eligible for the JobKeeper, and once the employer is eligible, it remains eligible for the duration of the period. There is no further requirement to test decline in turnover, and even if there is an increase in turnover subsequently, that JobKeeper subsidy will still remain available. Now, the JobKeeper is also available for eligible business participants, and an eligible business participant is one person who is nominated in relation to a company, where it's a company, is a shareholder or a director of that company who is actively involved in the business. Where it's a partnership is one partner. Where it's a trust, it's one beneficiary, or if you're a sole trader, you can be eligible for this. Now, any payments which are made under JobKeeper, unlike the Cashflow Boost subsidy, these payments are assessable income in the hands of the entity which receives the payment. Where this is an eligible business participant, there is no requirement for the entity, say if it was a company, to pay that payment across to the nominated eligible business participant. It remains income of the company. Now, while the income tax provisions are relevant, there are two other provisions which are impacted by this JobKeeper. The payments which are made under JobKeeper will be subject to superannuation guarantee, subject to two exceptions. The first exception is where that employee has been stood down and is just being paid JobKeeper while being stood down. The other exemption relates to top-up payments, payments which have been made to the employee because their salary would be below the $1,500 per fortnight, and the top-up is made to meet the requirement for this. Both of those will be exempt from superannuation guarantee. However, all other payments in relation to JobKeeper will still be subject to superannuation guarantee. So if you don't pay the minimum superannuation in relation to those payments, the business will be subject to the superannuation guarantee charge. The other important concession in relation to JobKeeper is the payroll tax concessions which are being provided by the relevant states and territories. All states and territories have, except for New South Wales and Victoria, have effectively announced a full exemption in relation to any JobKeeper payments which are being made to employees. So these payments can be excluded from taxable wages for those states and territories. For New South Wales and Victoria, there is only a limited payroll tax concession. The concession is similar to the exemption for superannuation guarantee in that the exemption only applies in relation to employees, payments which are made to employees which have been stood down, and top-up payments which are made to the employees to meet the minimum JobKeeper requirements. Moving on to some of the other concessions which are being provided by the stimulus for COVID-19, and that relates to the instant asset write-off and the purchase of new or used assets. In accordance with the instant asset write-off, it has been widely expanded for the period until 30 June 2020 by allowing the increase in instant asset write-off threshold to increase from the previous $30,000 to $150,000. It has also been expanded the number of business entities which can be entitled to this. All businesses with aggregated annual turnover of less than $500 million will now be entitled to the instant asset write-off. But this expansion only relates to assets which are first used and installed ready for use between the period of 12th of March 2020 and 30 June 2020. For businesses that have aggregated turnover from $10 million to less than the $500 million, the asset must have been purchased during the period of 2nd of April 2020. Where a business is purchasing a car, it needs to be noticed that the instant asset write-off is still subject to the car limit of $57,581. So any luxury cars purchased for $100,000, the instant asset deduction will be limited to the $57,581. Please note that the deduction that's available for instant asset write-offs is only available to the extent that the asset is proposed to be used for taxable purposes. And the threshold in relation to $150,000 is a per asset threshold. So you can the claim is available for multiple assets purchased during the year. So if you purchase 3 trailers worth of $100,000 each, you are entitled to a $300,000 instant asset deduction. It's important at this stage for eligible businesses to consider what sort of assets that they need in the not too distant future, and to determine whether they can get that asset, purchase that asset prior to 30 June 2020 in order to obtain the benefit of the deduction. But you must ensure that it is delivered and arrives ready for use prior to 30 June to obtain that concession. With effect from 1st of July 2020, the instant asset write-off is proposed to only be available for small business entities, being entities with turnover of up to $10 million and with only a threshold of being reduced back to the $1,000. Excuse me. So as a result, it is important to consider now whether any assets need to be purchased. For assets which haven't been entitled to the instant asset write-off, there is also accelerated depreciation deductions which may potentially be available. These accelerated depreciation deductions allow for a deduction of 50% of the cost of the asset in the year of installation, with the normal depreciation applying for the remaining life of the asset. Now this concession is only available for new assets purchased and installed ready for use from the period of 12th of March 2020 to 30 June 2021. So it actually has an additional year of application than the instant asset write-off extension. But note the difference between this one and the instant asset write-off is that the accelerated depreciation is only available for new assets purchased. It is not available for used assets which are purchased. Again, the aggregated turnover must be less than $500 million of the business that is acquiring that asset. Now, as a result of the accelerated depreciation deductions being available, it is only available where the instant asset write-off is not available. As a result, this measure will generally only apply before 30 June 2020 to new assets that cost more than $150,000. This is because the instant asset write-off will apply for assets that are below that value and assets that are installed ready for use in 2021. So it's certainly relevant now if the business needs any assets to determine whether an asset should be purchased. Further to the COVID-19 provisions, the ATO is offering a range of concessions to assist taxpayers with their cash flow. Now, these concessions primarily relate to lodgement concessions and payment deferrals. The payment deferrals which are available relate to business activity statement liabilities, fringe benefits tax liabilities, and income tax liabilities. Note, to get these deferrals in payments, you will need to contact the Australian Taxation Office for approval. They are not automatic exempt deferrals. There is also the ability to vary the PAYG instalments down to nil and claim refunds for payments that have previously been made. While this ability has been available previously, the ATO are now offering on application for no penalties or interest to be applied where there is a shortfall in the income tax paid at the end of the year. Previously, if you do vary your instalment down to zero or vary it down to any other number, where the variation results in less than 85% of the tax payable being paid by way of instalments, there will be penalties and interest imposed for the late payment. There's also ability to adjust your GST reporting method, where you go from quarterly, where you normally report on a quarterly basis, you can apply to change that to a monthly basis. However, this will generally only be a benefit if you usually receive refunds on the lodgement of your business activity statements. Now, while the deferral of income tax is great for cash flow, it will have an impact on a company's franking account balance. Franking credits are only available in relation to tax liabilities once they are paid. Accordingly, if you defer your tax payable, you will not get a franking credit until it is actually paid. If you obtain a refund of your PAYG instalments, the refund will generate a franking debit. If at the end of the year, at 30 June, there is a franking account deficit, then the company will be required to lodge a franking account return by 31 July 2020 and pay what is known as franking deficit tax. Now, the ATO have advised that there is potential to defer the payment of the franking deficit tax if desired. Franking deficit tax is not actually a penalty. It's treated as a prepayment of tax. So it can be used to offset your future income tax liabilities, generally without penalty. However, the general policy is if the total of your franking deficit tax is more than 10% of your franking credits for the year, then there can be a penalty for over franking your dividends during the year. And that is a reduction of 30% of the offset which is available under the franking deficit tax. The ATO have advised that if the deficit in your franking account is only due to a dividend paid before 1st of March 2020, then this penalty will not be applied. And so the full amount of any franking deficit tax can be applied against future income tax liabilities. However, you shouldn't be paying any dividends after 1st of March 2020, which will result in a franking deficit. Just looking at Division 7A, as you're no doubt aware, Division 7A is the provision which applies to treat payments and loans by companies to shareholders or their associates as deemed dividends unless certain requirements are met. It also can apply to treat unpaid present entitlements as being unfranked dividends in the hands of the trust, of the associates. There were a number of proposed changes which were due to have effect from 1st of July 2020, which were announced in last year's budget. However, this is expected to be deferred for at least another year, as there is currently no legislation being released in this regard. Notwithstanding these deferral, the ATO has announced a number of concessions which are being provided in relation to the requirements for meeting Division 7A. To prevent deemed dividends from applying, there's generally certain actions which need to be taken by the lodgement date of a tax return. However, due to the extensive deferrals of lodgement dates for this year, the ATO have advised that the deferred lodgement date will be the relevant date for undertaking these activities. Now, the deferred lodgement date is the actual date of lodgement of the tax return, or the deferred lodgement date as approved by the Australian Taxation Office for that entity, whichever is earlier. The effect of this is that 2019 unpaid present entitlements will be treated as loans if they are not put on a subtrust or paid by the deferred lodgement date. In relation to other actions which need to be taken by the deferred lodgement date, 2019 loans which have been made by the companies to the shareholders or associates of shareholders must either be repaid or put under complying loan agreements to prevent a deemed dividend from arising before that deferred lodgement date, or whether a payment has been made, this payment must be repaid or converted into a complying loan prior to the deferred lodgement date to prevent a deemed dividend. Should be noted that where a complying loan arrangement is entered into, there is a requirement for you to make minimum annual repayments in relation to that loan in each year prior to the end of the financial year. As a result, any loan agreements which are entered into to prevent deemed dividends arising in relation to the 2019 year, the first minimum payment must be made by 30 June 2020. There is no extension in relation to this date. If it's not made by this date, then any shortfall in that payment will be treated as a deemed dividend in that year. The next area we just want to mention is trusts. Trust is still an area of focus for the ATO, as it has always been. And one of the main issues to determine in relation to trusts is to determine the trust distributions that are going to be made by 30 June and to make the required distribution minutes for those distributions. In this regard, it's best to analyse all the income and capital gains and dividends which have been derived by that trust during the year and distribute them to the appropriate beneficiary. Where a trust does not have a corporate beneficiary at this stage, one of the considerations will be to determine whether a corporate beneficiary should be incorporated prior to 30 June, and so distributions can be made to that entity. Before doing this, you must check the trust deed and make sure that a company can be appointed as a corporate beneficiary. And the other issue to do is to examine any unpaid present entitlements and trust distributions for the potential of Division 7A, as we mentioned in the previous slide. Just need to ensure that no deemed dividends are being paid as a result of unpaid present entitlements. Moving on to individuals. One of the big changes for this year, which takes effect from 1st of July 2020, applies to foreign residents. As a result of the changes, foreign residents will no longer be entitled to the main residence exemption where a sale is made while they are a non-resident, unless they satisfy a life events test. Now, the life events test is very limited. It requires that the individual must be a foreign resident for a continuous period of less than 6 years, and that one of the following has occurred in that period: that there is a terminal medical condition of the individuals, the spouse or their child under 18, a death of the spouse or child under 18, or a CGT event was as a result of a distribution of assets between spouses as a result of a divorce, separation, or similar maintenance agreement. Note that this provision is quite draconian for people that have become foreign residents, in that there is no partial exemption available. So a person could have owned a home and used it as their main residence for 19 years and just ceased to be, and is now just a foreign resident over the past year and does a sale. They will not be entitled to any part of the main residence exemption if they sell after 1st of July 2020 and they are a foreign resident at that time. So foreign residents need to determine whether they should be selling their home at this point in time prior to 30 June 2020, and one of the considerations in this regard will be whether they intend to come back to Australia and live. Because if they do come back to Australia and recommence their residency prior to the sale of the property, the main residence exemptions are available again. Now, note that there are conditions under the main residence exemption that still need to be satisfied. So whether the person's entitled to a partial main residence exemption or a full main residence exemption will still need to be analysed. So for foreign residents moving into 30 June 2020, it'd be essential to assess straight away whether they should be selling or restructuring the ownership of any homes that they own that would be considered to be a main residence. For individuals, working from home has become one of the major issues for this year. There's always been deductions available for home offices for individuals. These generally fall into two categories. One, where a home is used as a place of business or income earning operations. This is generally where a doctor's surgery is attached to the person's home, or a separate office is attached to the home of which clients come into. Alternatively, home office deductions are available where it is just used as a place of convenience, where there is a separate dedicated work area for conducting these activities. Now, the type of home office that you have will determine what sort of expenses are claimable. Occupancy expenses are generally only claimable if the home is a place of business. Now, occupancy expenses can include the portion of the rent which you are paying in relation to the property, interest deductions, council rates, land tax, any of those matters. Note that if you're claiming occupancy expenses, it will impact the main residence exemption when you eventually sell your home if you own it. The second type is running expenses. These running expenses are available if there's a dedicated work area in relation to your property to conduct your home office activities. To determine your running expenses, you can use actual costs, the additional costs related to that area which is used as your home office, or the simpler method of a fixed rate of 52 cents per work hour. The substantiation of the work hours generally requires a diary representation for 4 weeks, of a representative period of 4 weeks. Where working from home, depreciation and other expenses are allowed in relation to equipment such as phone costs, stationery, computers. As a result of COVID-19 and the large number of people now working from home, ATO have introduced a shortcut method for applying a home office deductions. This applies from 1st of March 2020 and will be active at least until 30 June 2020. It may be extended after this date. The rate at which the deduction is available is at 80 cents per work hour. The benefits of using this method is that it is available for multiple individuals within the same household. The usual rate was only available for one person in the household. There is no requirement to be a separate dedicated work area to claim this deduction, and there is a simplified record keeping requirements. This can be done by a diary entry for how many hours that you've worked at home, or can be used using timesheets for people that do timesheets for their work life. However, where you use this method, there is no additional deduction for additional costs such as depreciation, stationery, or additional phone costs. The deduction for the 80 cents per hour will limit the deductions available for work for these items. Just moving on to superannuation. Superannuation is always an area which involves detailed analysis, but we won't be doing that in today's seminar. We'll be addressing this mainly in a seminar which we are holding on superannuation considerations next week on the 28th of May 2020, which is next Thursday. But just a few key items in relation to superannuation. The issues that need to be determined is whether you should be making superannuation contributions by the 30th of June 2020. If you are making contributions, you have to determine whether you wish to claim a deduction or not. Where you're claiming a deduction, the limit for the year is $25,000 for the year. This includes not only your personal contributions, but any contributions made on your behalf by your employer. Your personal deductions are limited to your taxable income. You cannot claim a deduction for superannuation to the extent that it will result in a tax loss. For people that are on pensions in relation to their superannuation, need to ensure that a pension is drawn down by 30 June 2020 and note that the drawdown rates have been halved for 2020. As a result, the taxation issues for this year still do involve, for the most part, deferring derivation of income to a future year and bringing forward expenditure where possible. There's a number of considerations that were mentioned, such as bringing forward asset purchases to take advantage of the instant asset write-off. Also consider whether to make any donations to deductible gift recipients or superannuation contributions. And one of the other usual ones is whether you should be prepaying interest on investment loans to further reduce your income. Note that this is only beneficial for individuals or SBE or small business entities. As a result of that, it just gives an outline of the different taxation considerations which need to be taken into account this year. We'd recommend that everybody assess their taxation position at the moment and talk to their taxation advisors to get a better outcome and ensure that they're achieving the best positions that they can at this point in time. I thank you for your attention and pass you back to Michael.
Thank you, Gabrielle, for that presentation, which was jam-packed full of many issues and lots to digest. I think we've got a number of questions. Gabrielle, I might give you a rest for a moment and start going straight into our tax panel. And to introduce our tax panel, first of all, we have Jamie Towers. Now, Jamie's a tax partner from Brisbane. Hi, Jamie.
Yeah, hi, Michael. Hi, everyone.
And the other person on our tax panel is Evan Bysor, the tax specialist from the Melbourne office. Hi, Evan.
Good morning.
And Gabrielle will join the panel if we'll see how the timing goes with the questions. And so perhaps, Jamie, I'll start with a question for you. The question is, the question's from Richard, and it's a question, something that really many people are experiencing. So Richard says, my wife and I are working from home for the first time. I have a new laptop and our internet use and phone calls have significantly increased. So do you recommend that we use the ATO shortcut method for calculating the home office expenses? So Jamie?
Yeah, great question. Look, there's no right or wrong answer here, and but it will depend on everyone's circumstances. But the simple way is all you've got to do is keep a diary of how many hours you work at home. You don't need to have a dedicated space, and so you can work from anywhere in the home, and it's just 80 cents per hour times by the number of hours you've worked from the 1st of March to 30 June. It's a very simple calculation. So if you're working 40 hours a week from March till June, you're going to get over $500 of tax deductions. And that applies each individual in the house that is working from home. The thing you need to consider though is if you've got a brand new laptop and you've got a very high work-related phone and internet use, you might be leaving some deductions on the table. So then you need to consider whether to keep more detailed records, as Gabrielle discussed before, to work out which is the best method to use. So if you were to keep a diary for 4 weeks, which is a tax office recommendation of the amount of time you're spending in the home office, you're then able to claim a percentage of your electricity, depreciation on your laptop and any other business equipment at home, and then also a business percentage of your phone use and also your internet use. So if you were to do a bit more work, you can then compare whether or not you're better off to use the 80-cent shortcut or the more detailed method.
Okay, thanks, Jamie. We'll keep moving through. Perhaps, Evan, if I can ask you a question. I've got a classic question here from Adrian. He says, my wife and I run our business through the family trust, and we estimate profits this year of $300,000. And during the presentation, it mentioned a corporate beneficiary. Should we be using one, Evan?
Yeah, another great question. Look, it really comes down to how you're going to use those funds. If all of your profits, if you're going to be using them personally, or if you're going to be reinvesting them in the business, then at best you're going to achieve a deferral of tax using a corporate beneficiary. So yes, there's clearly an upfront advantage for $300,000. If you split that between 2 individuals, the top slice of income will be taxed at 37% compared to a company tax rate of maybe 27.5%. But if you're using it personally or using it in the business in the trust, you're going to have to pay that out of the company as a dividend and pay the additional tax at personal rates. However, if you're able to set aside those funds, you can get an advantage by using a corporate, or maybe for some people that deferral is still very valuable. So it really comes down to your circumstances, and it's important to talk to your advisor to get that right advice.
Oh, good. Thank you. Thank you, Evan. Gabrielle, if you're ready, I've got a question particularly for you coming from the presentation from Jane. Jane says, I want to purchase a new car for around $50,000, which can be delivered before 30 June 2020, and I'm considering leasing it. Is this the right thing to do to get the 100% tax write-off? Gabrielle.
Thank you, Michael. Unfortunately, if you lease it, you will not get the 100% instant asset write-off. In order to get the instant asset write-off, you need to purchase the vehicle or hold it under a hire purchase arrangement where you're treated as purchasing the vehicle. So you need to actually hold the asset. So to get the 100% deduction, because the $50,000 is less than the car limit, an instant deduction will be available if you purchase the vehicle. If you're only leasing it, you'll only get a deduction in relation to the lease costs on an annual basis. You will not get access to the instant asset write-off.
Okay, good. Thank you, Gabrielle. Now keep the questions coming, because even if we don't get a chance to answer them now, we'll post all the questions and answers on our website after, and that way people can come back to them. So perhaps Jamie, if I come back to you, I've got a good question here from Natasha. Natasha says, my husband and I run a business through a trust, and we received $50,000 of Cashflow Boost. So if we distribute the $50,000 to ourselves, 50-50, will we pay tax on that distribution, Jamie?
Yeah, that's a really important consideration, Natasha. Now, the Cashflow Boost is regarded by the tax office or under the tax law as non-assessable, non-exempt income. Now, what does that mean? So that means that you're not going to pay tax on the income, and the non-exempt means that you don't lose any losses that you have. Now, where you earn that within a trust, it does form part of the income of the trust estate, and the trust can distribute it to any beneficiaries that it nominates. So the income should flow, the Cashflow Boost should flow through the trust to you and your husband as beneficiaries, and in your own name, that should also be regarded as the non-assessable, non-exempt income. So short answer, you won't pay tax on it.
Great. Thank you, Jamie. Another one now, perhaps I'll go to you, Evan. It's from Heather. It says, my business is run out of a trust. Now, with the company tax rates coming down, would I be better off operating through a company? Evan.
Yes, look, there can be advantages in operating through a company, but it comes down again to your the circumstances of your business. So, for example, if you are a growing business and you need to reinvest your profits in the business, a company can provide a good environment to take your profits, pay tax at the company rate, say 27.5% or 26% next year, and then reinvest those profits in the business without being taxed in your personal name. But if you're drawing profits out of the business every year, a company may not provide a significant benefit. If you sell your business and you're selling the assets of your business, a company doesn't get the CGT discount, so may be taxed at a higher rate. So it really comes down to your business and what your goals are for the future.
Okay, good. Thank you, Evan. We'll keep moving along. There's a few more questions here. Gabrielle, there's a question here from Adam. Adam says, I want to purchase a rental property and I have $300,000 of retained profits in my company. So can I use these profits to lend money to myself and negatively gear a property? Gabrielle.
Thanks, Michael. A very common question that's made. The short answer is yes, you can borrow the money from the company to make the loan and purchase the asset, but you will need to comply with Division 7A. If you don't enter into a complying loan agreement in relation to that loan, you will end up paying, that loan will be treated as a deemed dividend in your hands. So to enter into a complying loan, you can either enter into a 7-year loan arrangement, of which you pay payments regularly over that 7-year period, or you can enter into a 25-year loan in relation to the property, provided you've got a registered mortgage over that property and the market value of that property is at least equal to 110% of the market value of the property at the time of the loan.
Okay.
And you will need to make annual repayments in relation to that loan to prevent Division 7A from applying.
Yep, always a Division 7A trap there for the unwary. Well, we'll just try and knock off a couple more before we finish. Evan, I've got a question here, perhaps I'll direct to you. It's from Robert. It says, Robert, I heard mentioned during the presentation of ATO focus on trusts. So what is the focus of the ATO with trusts and what should I be looking out for?
Yeah, no, look, really good question. Look, trust can be a tax efficient vehicle for private business and investment, but over time some people have pushed the boundaries of what's allowed, and the ATO is wary of taxpayers that may be managing their trust in a way that's not compliant with the law. And so the ATO has established a trust task force to review trust arrangements, particularly within complex and high wealth family groups. One area that's the ATO is particularly interested in, for example, is arrangements where maybe a number of family members receive trust distributions, but they don't actually receive the money. So it's really important in this area to make sure you're getting the right advice and you're managing the trust correctly. Trusts offer lots of flexibility, and this is a good thing, but there's no one-size-fits-all solution. And this is an area where you really should be talking regularly to your Mazars advisor to determine the best strategy for your circumstances.
No, I think we better finish it there rather than start a question and not be able to answer it. So thank you everybody on the panel for helping out with those answers. Other questions that we can put up and post on our website when we get a chance after the webinar's finished. So really the next step now, I think, for people to do is really to schedule an appointment with your Mazars advisor to discuss your particular circumstances if you have an issue, because really there is no substitute for a comprehensive discussion with your tax advisor. Presentations raise the issues, but you need that discussion with your tax advisor. In about a week's time, we'll have a tax planning checklist up on our website, which will be available to be downloaded and used just to make sure you've covered off on your housekeeping and year-end matters. And I will take the opportunity to remind you that next Thursday, 28th of May, we'll have a superannuation update covering all the specific matters for superannuation. And as part of that webinar, we'll include some economic insights and the economic outlook over the next year from Professor Neville Norman. And Professor Neville Norman will always provide a very interesting presentation. So I look forward to seeing you then. So thank you for joining us today. I remind you that a record of the presentation will be sent to you following the webinar. And you'll be able to watch on demand by clicking on the same link that brought you this webinar today. So thank you very much and goodbye.